Hi there and welcome to Markets Today. I'm your host, Mbithe Mwema. Now, a couple of things are happening globally in as far as oil prices are concerned. I wanted to take some time today just to have a quick teaching and help you understand what is happening when people are talking about oil today. What does it mean for you, especially if you have a car and you have to fuel in the next couple of days? And more importantly, what does it mean for different investment classes in Kenya? To start us off, let us look at what happened overnight in the US oil futures markets. We saw the May contract close down at a price point of $38 per barrel. That was a negative price point of $38 per barrel. This has never been seen in the history of trading oil. You and I and your parents as well have never seen a negative price point for anything that is related to oil. Yesterday was a first. What we do know is that at the end of any contractual agreement that has to be traded, in this case, the May contract, there's always a bit of price volatility because there are some traders who have to close out their positions, and this is always expected. What was unprecedented was the fact that we actually went to a negative price point of $38 per barrel. That's negative $38 per barrel. That's the technical way of looking at the oil market, at least in the US. But what does this really mean? What this means is that yesterday, there were a couple of traders who had a position in the May contract. Now, put a pause in that statement and try and imagine how oil looks like in a barrel. It's sold in barrels. It's a very hefty thing to move around. So then what people have done in the financial market is to decide we will create a market which is futures and be able to trade oil in advance of a 3-month futures, for example, rather than actually physically trading in oil. If it was as light as bread, perhaps people would have traded in it physically, but because of the weight and the logistics that are affiliated with it, people typically trade the futures market. That said, these futures are normally in sets of 3 months, and when they come to the end of the expiration date, then the person who's holding a future has to decide, will I take delivery of this oil, in other words, these barrels, or will I actually trade off this future so that I don't have to take delivery of this? That's a very important point for you to bear in mind as we go along with this conversation of oil. Here is why. Now, COVID has happened and it has had a very negative impact in as far as demand for goods, especially oil, is concerned. In the US alone, people are actually in a space where they're producing more than the US or even the global market can actually consume. It's such an expensive affair to produce oil that the producers in the US are willing to produce and sell it at a negative price point rather than stop producing. Because when you put off these production facilities for oil in the US, it could take a very long time to bring them back on board when demand actually demand actually increases globally. So what I'm really saying is this: you're in a space in the US market where you're selling oil at a negative price, and you have to, because if you don't, you will be stuck having to store oil in your storage facilities, and there's no space for it because nobody is buying it. Secondly, it would be rather obvious, or it would make common sense for you to put off your machinery that deals with drilling for oil as well as producing this oil. But if you do that, it will be more expensive for you to actually switch back the lights on when the world goes back to normal or a near normal once this COVID pandemic is done. You're really hard pressed against a wall, and you're damned if you do, you're damned if you don't. That's really what happened yesterday. Now, remember, when we started this conversation, we did talk about futures. Now, the way futures trade for the May contract, the last trading day was 20th of April. Meaning that if you had any futures contract for oil in the US, then you begin receiving the physical product, which is oil, from the 1st to the 31st of May. If you're not willing to receive that oil in May, then you're forced to sell and close that position as at yesterday. In other words, every 20th or 19th of the month, depending on what trade day it is, there's always volatility, because there will be some people who say, I have this future, but hey, I don't have the space to hold the oil, so let me sell it. So yesterday's market was effectively saying, I can't afford to hold this oil. There's no space for it. No one will take delivery for it. And the market dynamics actually changed. Rather than you, the buyer, paying the seller said, I will pay you as much as $38 per barrel for you to take this oil off me. That has never happened. I don't know if it will ever happen, but it was a first. What's the read-through from this US oil market, and what does it mean for Brent? When you look at the May contract, most of the analysts that we listened to and engaged with said it was good to know, but it was more of an irrelevant price point. They did tell us to look out for the June contracts as well as the September contracts. In our show, we actually have a very interesting conversation lined up for you with Mr. Nahashan Mungai, who is the portfolio manager for the Mansa X product that deals in oil futures as well as other alternative products. Now, we shot this show earlier today in the morning, and we discussed the June contract with him. At the point of recording, the June contract was at $20 per barrel. At this point in time, it went down to as low as $11 per barrel, and it's now titillating at about the $14 per barrel level. What that tells you is that there's so much volatility happening in the oil market today that in as much as I would like to get all this information and have it delivered to you in a timely manner, it's becoming virtually impossible to do that. Now, the traders are looking at the June contract and the September contract as an indication of what to expect for the oil prices. When we have seen the June contract go to as low as $11, then what the world is telling us is, at this time, we really don't have need for your oil and we don't have to pay for it. That is really what's happening in the US oil markets. And if there are any data points that you would like to be informed or rather keep tabs on for your own benefit, I'd say keep looking out for the June contract prices as well as the September contract prices for the US oil market. Let's move across to now the Brent crude market. Brent crude is what we here in African and Asian markets consume. More specifically for Kenyan, we do consume the Marban crude, which is more or less priced at a similar price point to Brent. Yesterday, Brent was largely unchanged at about $25 per barrel. By the time I was coming to have this recording with you, it was trading at $20 per barrel. It had touched a low of about 19.5, but now it's back up to $20 per barrel. The read-through from what is happening in the US oil markets vis-a-vis the Brent crude markets is this. The sentiment is bearish. Nobody wants to take delivery of oil. Everybody wants to sell oil as fast as they possibly can so that this volatility that we are seeing in US oil markets is trickling down to other markets and it's affecting the price of Brent. What does this mean for you if you are a Kenyan? For Kenya, the government of Kenya is a net importer of oil. Any volatility, any price movements downwards are actually a huge positive for the Kenyan government, at least as far as the current account deficit is concerned. Central Bank of Kenya last month during its Monetary Policy Committee meeting indicated to us that it had been using the price point of about $25 per barrel, and based on this, it had already priced in a benefit of about 4% to 4.9 percentage points in as far as the downward correction of the current account deficit compared to the gross domestic product. In other words, the CBK was saying that we will now be paying considerably less for receiving oil, or rather fuel, for the economy, and that's a good thing and it's positive for us. But conversely, they said that we will not be receiving as much money as we are accustomed to from tourism or from selling flowers, coffee, tea, or diaspora remittances, so that both sides of the equation are balancing out and not necessarily giving Kenya that much of a huge benefit in as far as the macros are concerned. And finally, when now you look at this and the pump prices, the world is paying negative for fuel. You're paying 90 shillings, or at least between 90 and 92 shillings per litre of fuel, depending on where you're at. Technically, based on the information that's coming out globally yesterday and today, really, you should be driving your car to the petrol station and they should be, pouring out oil into your car and pumping it into your car. That is not going to happen because there are structural adjustments that need to be done that might not actually have any impact on the price that you pay. But what it really needs to be looked at from your own perspective is in this way. We are seeing a shift, a great fundamental shift in the way the pricing of oil is being done globally. What does this mean for the other asset classes? What we did hear from our conversation with Nahashan is that we should be paying attention to some currency pairs that actually trend the way the oil price is trending. One of the pairs that he mentioned was the US dollar trading, the US dollar and the Canadian dollar pair. So that is something that we would need you to be able to look at, especially if you're looking at the Forex market. Over and above that, for us here on the Nairobi Securities Exchange, we haven't seen much volatility on prices. We've seen Safaricom hold steady, but we continue to expect foreign investors to sell out of the stock market. My personal view is this. The bearish sentiment that is happening in oil and in different asset classes globally, it's only a matter of time before it trickles down to Kenya. Kenya is supported largely by the foreign investors that typically make up about 70% of turnover. Now, because they're all getting into a stance of risk aversion, I expect them to keep selling. The locals will be able to buy and maybe sustain the prices. But once this COVID pandemic actually sets in and affects the economy, then I will expect lower profitability from the companies. What I'm saying is that there could be a 10, 15, even 20% downward correction on the prices that we see on the Nairobi Securities Exchange. It's important for you to hold your cash when you see opportunities, then to tap into them. This is certainly a whole lot of things that we're talking about, but what I would encourage you to do is to be able to just have a replay of this, have a rethink of what we have discussed, and if there are any questions that you would like me to elaborate, you can reach out to me on Mbithe Mwema on Twitter, or you can also look us up on Metropole TV, either on Twitter or Facebook or Instagram, and we would be willing to answer your questions. We take a short break. When we come back, we have our conversation with Nahashan Mungai about what's happening in the oil markets, what this means for your investments, and what exposure his particular fund in terms of Mansa X has had. Thank you, and we will see you after the break.